Kia ora, everybody. I can see some of you already sending in messages saying, has it started? And I know that's because you're all champing at the bit to get a little bit of information after the Reserve Bank Governor's decision to cut the official cash rate by, as promised, 50 basis points. But we also know that lots of people are floating or coming off short-term fixed rates, and they're all wondering what to do next. So we've brought together a panel of experts who I will introduce you to shortly, who are hopefully going to give you some of the context and the things that you need to be weighing up in making that next decision. But of course, I also need to say that we can't give you, in a group context, personalised financial advice. There is no substitute for seeing an expert. We intend this information to be just that, information, but useful information. So let it be the start of your journey rather than the be-all and end-all. So if you do have questions during this discussion, by all means, put them in the Q&A box so that I can keep on top of who's asking what, who's it's for, and whether or not it's been answered. So let me introduce you to our panel this afternoon. We are lucky enough to be joined by Brent Hunt, who, as you can see, is a wealth management subject matter expert at AdviceFirst. He's seen market ups and downs, and he is going to give us the perspective of those looking at fixed interest products and investing. Kia ora, Brent.
Afternoon. Afternoon, everybody.
And Hannah McQueen, she is the founder and director of Enable Me, and I think it's been 17 years, has it, Hannah, that you've been helping people get mortgage-free faster and grow their wealth. So again, she has seen many aspects of the interest rate cycle, so she's perfectly placed to give you some guidance. Hi, Hannah.
Hi.
And John Bolton, better known as JB, who is the founder and head of mortgages at Squirrel, which, as the title suggests, means he is dealing with mortgages day in and day out. Hey, JB.
Kia ora.
So let's start with you. What we learnt on Wednesday from the Reserve Bank Governor was that they're pulling forward the cuts that they were thinking that were going to go into next year. So what does that mean? Does that mean we should sit tight because there's more cuts to come, or something else?
Yeah, hey, good question. Look, I mean, we've been sort of saying this for a while, right, that the Reserve Bank was moving too slowly. It's in a response to a weak economy, low levels of inflation. They've got to get back to what they consider to be a neutral interest rate quite fast. They've been sort of a reluctant participant in that journey. You know, the market's always been ahead of them. And so, you know, we had that big rate cut in November. They signaled very clearly this time that they intended to do a 0.5% now, which they followed through with, which is good. But as you said, they've pulled forward their forecast to getting back to neutral. It was meant to be the end of next year, and now it looks like they'll be back at neutral, which they say is 3% OCR by the middle of this year, mid to late this year. But my pick would be the middle of the year. So that sort of means that we're getting back to, I guess, the bottom of a normal interest rate cycle. And if you've got a 3% OCR, you would expect your mortgage rates to be between 4.5% and 5%. Now, given that we've got 2- and 3-year rates out there now at 4.99, it sort of says that the rates are getting towards the bottom of where they'll get to.
Which is, I guess, the big question. So many people are saying, well, should I bide my time and wait for those rates to fall a little further? At least if my inbox is anything to go by, my clients are saying, is 4.99 good enough, JB, or should I be hanging out for it to be 4.5?
Yeah, I mean, we've got this preoccupation, this fixation with rates here. I mean, the OCR announcement, the whole economy comes to a grinding halt, and it's the big news story of the day, right? I guess it just shows how indebted we are. But yeah, look, I mean, the pragmatic side of me says rates below 5% are good rates, especially longer term rates below 5% are good rates, right? Those short term rates could and are probably likely to go lower. So they're higher at the moment. The 1-year rate's sitting about 5.2. If you were fixed for 6 months, you're at 5.5, and if you're floating, you probably may still have a 7 in it, but you know, at the very best, you'd be sitting around 6.5. So you're paying more to stay on short-term rates at the moment. Rates will fall, and they will fall reasonably quickly over the next 3 or 4 months, and I'd expect to see those shorter term rates heading below 5 quite soon. But they're not going to get a hell of a lot lower. So what you're really trading off is waiting to get to a short term rate of somewhere between 4.5% and 5%, but maybe let's anchor that around 4.7. Or the opportunity to take a longer term rate now at 4.99. Or a little bit lower, right? There may be a little bit of negotiation in those rates. The short end of the curve is dictated by our Reserve Bank and the state of the New Zealand economy. It's fair to say the economy has been weak. There's some green shoots showing, but it's still not great, and it's not going to recover quickly. So there's no silver bullet for New Zealand. We're in a slow, hard grind out of this recession. That's going to keep the short-term rates low, but there are green shoots there, and so I think I don't really have any expectation that the Reserve Bank's going to have to continue to ease to help the New Zealand economy. I think we will gradually recover from where we are now. Those longer term rates have been very much driven by what's happening overseas. And yeah, you've got the whole Trump factor, which is so bloody volatile at the moment. I mean, it changes daily, right? And so so those longer term rates, with the amount of uncertainty that's out there, I kind of feel anything below 5% to get that level of certainty for that long is pretty attractive.
We are going to talk more about mortgages in just a moment, but someone has already pointed out, and we are getting to this, please address the issue for those of us whose income is decreasing because interest rates are dropping. So that's where I'd like to bring you in here, Brent. That's incredibly relevant, right? Because cuts to the official cash rate don't just affect mortgages.
That's the other side of the coin, isn't it? That you're pushing the rates down to grow the economy, bring the mortgages up, get everything moving again. But the people that I guess hurts, for want of a better word, are those that have got their fixed income and that are looking to do that. Really, the best answer I can give there is that having a range of income streams or a portfolio that gives you different income streams that benefit in different environments is the best way to go. If you're solely relying on term deposits and straight out interest, then you're definitely going to suffer in these times and see your income going down and you've got no control over it.
Well, there's another question here saying basically, is it worth now having a term deposit in the bank, or should I be looking instead to managed funds? I guess what they're looking for is a slightly better return than what those term deposits will soon be. Yeah.
Look, it really does depend on your own personal circumstances, and as you said right at the start of this, getting some specialist advice is really what you need to do. However, term deposits and interest and cash and all that has got a place to play in a portfolio. However, if you do want to get some income and get a better return than what's happening now, you're going to have to spread your wings a little bit and perhaps accept a little bit of volatility, a little bit of up and down in your portfolio. But to get that income coming in all the time at a reasonable rate that's going to help you, you need to have some different assets in your portfolio generating that income for you, and that's what we can do for you, if you like.
Hannah, all of this discussion about securing the best interest rate is all fine and good. And look, we'd all take lower interest rates if we can get them. But just because we lock in a lower interest rate doesn't necessarily mean we're going to pay it off any faster. So is there something that needs to accompany the lower interest rates?
Yeah, I think that we've got to recognise that as interest rates start to low and as the economy starts to grow, we're coming into good times. And the problem with Kiwis with good times or better financial times is that lower cost, which should mean they have higher savings, translates to other costs creeping in, and we're still not making any faster progress. And I think the key, if you want a wealth mindset, we're coming through a winter. No one likes a winter. We've got the start of spring, but are you ready to capitalize on it? And how do you know that you are capitalizing on it? Because before you know it again, we'll be through a cycle and we'll be back to winter. So we've got spring, summer, and we've got to harvest what we've sown. So this is the time to sow. This is the time to take advantage of lower interest rates, to start paying your mortgage off faster, making sure you can re-access that extra capital you're paying down so you can understand other investment opportunities as well. If you don't have debt, so this is a good time to be paying off debt. If you don't have debt, then we can be investing outside of that, which is sort of what Brent's talking about. But if you have money in the bank earning interest and you have a mortgage somewhere else, you'd be better to pay off that mortgage rather than keep the money in the bank, provided you can re-access those funds. Like the flexibility of that, like don't underestimate how important it is to have that structured correctly.
Do lower interest rates change that calculation at all though, Hannah? You know, I know some people will say to me, oh, if interest rates are lower, should I be investing my money elsewhere and continuing to pay the interest on my mortgage?
Yeah, well, that's a separate thing, right? So the first thing we're saying is, look, the mortgage rate tends to be higher than a savings rate. So you'd be better to pay off a mortgage to save interest rather than save the cash and earn interest. You'll save more than what you'll earn. So that's the first thing. The next question, which you're asking, Nadine, is, but should I pay off that mortgage or should I invest in other things? So if the interest rate's going to, if we're going to anchor it to the 4.7% that JB suggested, well, you would need another investment to perhaps be giving you a 6 or a 7% return after tax, or before tax, sorry, to give you a similar return after tax as the mortgage saving would be. But remember, the mortgage or that interest saving is a guaranteed saving, whereas if you're investing elsewhere, it needs to be at a higher rate, and it also needs to address the volatility or the lack of certainty that you do get from those fixed returns of mortgages and term deposits.
Yeah, Brent, you and I had this discussion yesterday, right? There's no such thing as a risk-free return anywhere else, really, except for paying off debt.
Yeah, and as we said, yesterday, a few years ago, when interest rates were ridiculously low, historically low, there was the question, could you actually do better by leaving your mortgage in place? That probably not going to be repeated in our lifetimes, I suspect. So yeah, the certainty of actually having that gain from paying off the mortgage is a big factor in it. I'm a big fan of being able to save a little bit as well as paying down that mortgage. I like the discipline of both, but most people have KiwiSaver, and so that's taking care of that for you. So yeah, getting rid of that debt is paramount.
JB, there are some questions that have come in from people who are maybe fixed for a little longer in the high sixes.
Yeah.
And they're wondering, is there any rationale that would lend you to break that rate to try and take advantage of the shorter term rates, or is it just going to be too expensive?
Yeah, so like as most people will be aware, if you break a fixed rate loan, you incur what's called a break fee. Now, in simple layman's terms, the break fee is the difference in the interest rate between what you're fixed at and the mortgage rate that's available for the remaining fixed term that you're on, multiplied by the size of the loan over its remaining term, right? So if you're on an interest rate of, say, let's say 7%, and you've got 1 year left on the mortgage, and at the moment a 1 year rate is 5.2, that difference is 1.8 times your loan balance times its remaining term. And so the best thing to do is just go to the bank and ask for a break quote, and then work out how much you're going to save relative to that. Now, what I can tell you is that generally the cost, the break fee, will be equal to or possibly even higher than the benefit of breaking. So generally it doesn't make sense. The only time that I would encourage someone to break is if they've got cash flow issues and they want to free up cash. Then breaking your loan and potentially refinancing at the same time, you can get a cash back, and that cash back can offset the break fee, but get you to a lower rate sooner and therefore start to free up some cash flow. But generally it doesn't make sense.
Yeah, there are no free lunches here, especially when you're dealing with the banks. There is another question here about, and I think this is a little bit of crystal ball gazing, I guess, but to what degree do you think that future rate cuts are actually already baked into the rates that we're looking at now, or should we expect rates to fall further over the coming 12 months? What do you think, JB?
Yeah, look, the market's already anticipating it. So these mortgage rates that we've got out now are already anticipating the future rate cuts. Whilst the Reserve Bank brought forward its forecast, on Wednesday, the reality is the markets had already done that. The markets had already kind of felt that the governor would have to bring his rate forecast forward. So it's already priced in. And that's why we're not really going to see much movement in those longer term fixed rates. They're largely done, right? It's only the shorter term rates that will be responsive to actual OCR decreases. Now, the governor came out and pretty much has said to expect, a 25-point cut or 0.25% decrease in the OCR at the next 2 OCRs. The OCR, I saw a question come through earlier, OCR announcements every 6 weeks. So within the next 3 months, we know that we'll be down to an OCR likely to be around 3.25, and I'd suggest by the middle of the year we'll be at 3%, which gets you to those shorter term fixed rates somewhere between 4.5 and 5, but let's call it 4.7.
Brent, there's a question here, does this affect bonds too? And I guess you might need to explain for those who aren't so familiar with bonds as opposed to other investment products, well, they are, but a lower official cash rates that also flow through to bonds, and I guess the share market too.
Yeah. So bonds are what they call fixed income. It's essentially a debt instrument issued by a bank or a business that says we'll pay you X amount of interest, every month or every year or whatever it happens to be. And you've got fund managers that trade those bonds, so they're tradable on a market. So when you've got a bond that you took out, that you bought off a business last year at 6%, and interest rates are now at 5 or 4%, that bond is theoretically worth more. So what you've got is a situation where bonds are still earning 5s and 6s and possibly even more because corporate, paying more. And they're actually gaining in capital value as well. So they're actually contributing to a diversified portfolio as we speak, sort of thing. And the bond managers have been pushing out what they call a duration. So when interest rates are falling, they're squeezing that, so they're only taken out for a year, sort of thing. As interest rates are now, when interest rates are rising, now they're falling, they've sort of pushed that out. So they've got 4 or 5 year bonds now worth more. So what we should see is your income side of your portfolio contributing to a portfolio. Now, those are not things easily accessed by your average punter in the street. So you tend to have to go through a portfolio or that sort of thing. Similarly, for the share market, interest rates going down should be good. That they're going down because, as JB said, we're in the doldrums, we're in a recession, we're trying to come out of it. There's green shoots showing. So what you should see is the market starting to move forward as they anticipate that growth in New Zealand companies and that sort of thing. The key here is New Zealand's a pretty small part of the entire world. And so, again, you come back to that whole concept of spreading your wings a little bit, having a diversified portfolio that takes advantage of what's happening in the rest of the world, because New Zealand does have to sort of take a lot of stuff from the world. We can't influence it in a great way. And if you just look at what happened in the last couple of years, New Zealand share market went ahead by about 13% over the last 2 years. The US market went ahead by 55%. And the bulk of New Zealand stuff went in the last 6 months. So that's why you want to be in a, as I say, spread where you get your income from. Talk to someone who knows what they're talking about, and really focus on what you want to get and make sure you're managing that.
That's right, because diversification doesn't just mean a whole lot of different industries in New Zealand. There's the whole globe to consider as well as different
diversification is your friend. Yep.
Yes, indeed. Hannah, JB just mentioned before, the incentives and the cashbacks offered by different banks in the context of if you were trying to break and maybe offset some of the cost of that. But are there other opportunities to make use of that strategy, especially if you're all fixed short or all floating at the moment?
Yeah, so one of the things probably just to add is normally you have to pay the bank you're breaking with first before you get the cash back from the new bank. So sometimes coming up with that cash might mean you've got to get a mortgage to pay for it. Just, I guess, the tactical side of how we do that. Look, this would be, if you are going to refinance or restructure, I'm a believer of, well, let's anticipate what we need for the next 5 years, not just the next 5 months. So with interest rates coming down, that does mean that we can fix for a longer period of time. And typically we would fix for a portion on a revolving credit, a portion for 1 year, 2 year, and maybe up to 3 years now, which is what, haven't had that conversation for a few years, like pre-COVID when we were fixing for long term. So that's one thing, and that's to do with the strategy of getting you paying off your mortgage at a faster pace, benefiting from a lower interest rate on a diminishing revolving credit balance, and also giving you the flexibility of re-accessing that progress. So that's part one that we would be looking to consider. But also as part of that complete restructure, we're thinking beyond you getting mortgage free, or simultaneously, can we get your equity working for you? And so this is if you, of course, don't have cash reserves sitting somewhere else. We might need to borrow against that equity and think about getting an investment property, as an example, if that's your only wealth strategy that you've got at this point. So when we refinance, we are anticipating or trying to take advantage of the here and now. We're anticipating the rainy day, and we're trying to maximize your wealth at the same time. And all of that can feed into how you structure your mortgage, whether you're with your current bank or with another bank. And as you structure that mortgage, where we can, we try and extend the term to lower your fixed regular costs, which improves your cash flow, to improve your resilience, to increase your servicing, to qualify for more lending. So there's a lot of little levers that get pulled and have to be quite executed quite clinically and elegantly. And for example, if JB and I are working on a client together, just trying to coordinate all those loose ends and to tie them up is something that creates huge benefit to the client. They don't always appreciate it right then and there, but over the 5 years, they benefit from that work, and that's what you want. You want to be able to maximize, get maximum leverage from every bit of effort you put in. You want that to be leveraged further forward than what the actual effort would suggest.
Suffice to say that, assuming that this is just about 4.99 or 5.29 or whatever, is making it overly simplistic. The one thing I did want to bring in here, though, JB, is if you're talking about different banks, are they competing hard for our business at the moment? Are they trying to entice new customers with sharp interest rates and good cashbacks?
Yeah, look, it is quite competitive. If you look at banking overall, you could certainly argue that banking overall could be more competitive, particularly on savings and deposit rates, where I think Kiwis are quite hard done by. Savings interest rates here are terribly low. And so if I was a saver, I'd be keeping a close eye on actually how much interest you're earning on those savings accounts, because some of them have ridiculously low interest rates. But back to the mortgage side, look, it is pretty competitive. The banks are out there looking for market share at the moment. What's interesting is these 499 rates that have come in. The banks are competing on quite thin margins with those, or thinner margins than they've had for probably the last 6 to 12 months. And that's an indication of competition. That's an indication of them wanting to sort of protect their market share. Westpac obviously went with a 3-year rate at 4.99, which was quite aggressive. They were the first bank below 5%. And I think I've been anticipating that we would have a bank go below 5% because they can't help it. They really wanted to get the headlines, get that 499 rate first in market. It was a huge benefit to them. They got a significant lift in activity. And so they got the dividend from doing it as well, but it was at a much lower margin. They stepped away from that rate at this OCR change, I think, because they didn't really want to have too much business coming in at thinner margins. But ANZ's come back in there, and now what we sort of see is that most of the banks are now competing in that 2-year fixed rate space at 499. And we're seeing a large number of the banks also competing in that 3-year space at 499. They're not necessarily advertised rates, but they can be negotiated.
That is a really good point, that just because that's not what is on the website, that doesn't mean you can't ask for better. They can only say no, right?
Yeah. And you've always got the option to refinance, right?
Exactly. Just quickly, Brent, if people are looking at their saving, the bonus saver that is looking not very bonusy at the moment, or their term deposit rates, and feeling underwhelmed, how do they go about contacting you to take a look at their overall portfolio and see if there's another way to cut it?
Really, just give us a call. AdviceFirst enable me, get on the 800 number on the website, and you can call an advisor direct if you want to, and yeah, we'll have a chat through and see what you're after. That's what it comes down to. It's what you need to happen to make your life great. So we'll make that happen as far as we possibly can.
And on that note, if it's a mortgage you have and you need a strategy to execute some of the strategies that Hannah and JB have been talking about, then please come and see us, because I think, as we have already mentioned, just because interest rates are lower doesn't necessarily follow that you will make more progress. That needs to be a deliberate, strategic decision. So we do have an offer if you would like to come and see one of our advisors at Enable Me, who work hand in glove with the team at AdviceFirst and Brent's team, and also JB at Squirrel. So all you need to do is scan that QR code that is on the screen now, and you'll get a discounted consultation as long as you book it before Sunday. And if you are one of those people who has been biding their time and holding their breath, now is the time to do something about it rather than just continue to wait. If you haven't scanned the QR code, you can also just go to enable.me/OCR-update. So please do make the most of that, and hopefully we can give you some really useful strategies to translate lower interest rates into more progress rather than just more spending. So thank you very much to our lunchtime panelists. I know it's been short and sharp, but that's what we need at lunchtime. Thank you very much, Brent Hunt, John Bolton and Hannah McQueen, and thank you all for joining us.